Well, welcome to the Front Street Foundation Money Series. This is season 2 at Traverse Area District Library, and I'm really happy to kick off this season with a program that I think is it's more complex, frankly, than I thought it would be when I started researching the topic, and we're going to get into that. But first, I want to talk to you really briefly about a few things about the Front Street Foundation's Money Series and what it's all about. This is a nonprofit organization, the Front Street Foundation, and it has a signature program of the Money Series to educate people, to provide open access to financial education for everybody. And the concept here is to make sure that we put experts in front of the public on particular financial topics to educate them, but to not sell them. So the non-commercial element of the Money Series is critical. No business cards are available. There's no promotion of the speaker after the talks. It is simply to educate the public on a vast array of financial topics. We have these programs recorded live and rebroadcast on Channel 189 on Up North Media, Up North TV. And in addition to that, we take every program and we post them on our website on frontstreetfoundation.org. And they're all available for you to watch again, and are also available for you to pass along to your friends and family. Not everybody can attend a live program. And there's a lot of information that sometimes needs to be reconsumed along the way. And I would very much encourage people to share the links that are available online on frontstreetfoundation.org. And we've had some wonderful speakers in the past. We've got a season of 7 programs that go from this program in September all the way through April on a whole array of financial topics. So it's exciting to kick this off. The partnership and cooperation with Traverse Area District Library is very important. In addition to that, we have a partnership with the Senior Center. And the Senior Center programs, we do about 6 of them on smaller topics. We hold those on Wednesdays at 10:30 throughout the year. And we're doing one actually next week on IRA beneficiaries and other types of beneficiary designations and why it's important for you to get that right. So this program, first I want to make sure that you understand some value that TADL provides the public. This is a picture of all of the various periodicals. It's kind of a wealth of information that you as a patron of the library have access to without paying extra for. You support Traverse Area District Library through tax dollars. You are a patron of this organization. And I will highlight one in particular that I think is important to kind of show you the value. You know, down in the lower left of this slide, we've got a picture of Value Line, which to me as an investment analyst, there's something near and dear to my heart is the information that you can learn about specific companies, for example, through Value Line. Well, Value Line as a subscription costs about $600 a year for a professional to get. You get it for free, essentially, here at the library. And it's available for you online through TADL.org. It's also available in the print subscription upstairs. So the hundreds of dollars of value that you can get from the library is all right here. It's a wealth of information. And with that, I always want to encourage attendees and the listening audience that there is an organization called Friends of Traverse Area District Library. And it has a whole pile of community volunteers backing it. And its sole purpose is to provide supplemental programs for Traverse Area District Library patrons. You can donate to this organization. In fact, there are donation forms in the back. You can go online to tadl.org/friends. And for me, as a person who's works with TADL employees, they're quality people. This is a quality facility. These recordings wouldn't be possible without TADL. And to support them, I think, is to support a wonderful community asset. So that's the end of my commercial about TADL, but I do feel passionate about it. So launching into this program, I'm going to be talking about reverse mortgages, how reverse mortgages work. And I can tell you, my initial The topic is very complex. It's not as simple as I think I even thought it was. Reverse mortgages have a lot of particular details, and they apply to people in a very different way, in a very customized way. So I'm going to be giving you what I would describe as a pretty big picture overview of how they work, the nuances of reverse mortgages. I think that learning will be helpful. And then I want to talk at the end about some of the things that you really need to deeply consider about a reverse mortgage. Okay, the reverse mortgages in the industry, and I've been in the industry now quite a long time. It's hard to believe actually, but it's been about 18 years before I was an actuary. And reverse mortgages have gone through, I think, multiple waves of reputational evolution. And I can say that as a professional, I'm an investment advisor. I don't sell any products to anybody, first off, and I do not sell reverse mortgages. That's an important disclosure, I think, to make. Reverse mortgages are not something that I utilize for my clientele, but there's a use for lots of different forms of financial products. And part of this is to educate the public at a base level, to have them understand the things they need to evaluate before making what I would describe as a very, very big decision. And a reverse mortgage is a very big decision. So to set this up, I'm going to kind of always go back to basic principles to begin with. There is a traditional three-legged stool of retirement income. That three-legged stool is made up of savings, all of the stuff that you've accumulated in your life, and eventually will start to kick off income, and it will provide for you streams of income. In addition, there are pension plans, and pension plans provide a fixed payment for life. And I'll get into a little bit more detail on what's going on with pension plans and how the reverse mortgage fits into this backdrop. And lastly, there's Social Security. And I do programs specifically on Social Security because I think it's that important to understand Social Security. This is sort of the big picture. There's a search and a yield for income. And reverse mortgages fit into that search because I think what's happening, in some ways, pension plans are under assault, or they're degrading in terms of their prevalence, I think, out there for younger people especially. I mean, clearly there are pockets of industries that have the traditional pension plan still in place, but there are fewer and fewer pockets of industries that have that. So I want to show that, to begin with, the backdrop is we're seeing the three-legged stool in the form of, let's say, the pension plans becoming less and less common. We're seeing that decline happening, and it's creating anxiety in my view. In addition, we have interest rates that have plummeted, and really it's been a 30-year story of declining interest rates, generally speaking. But the last decade, or close to the last decade, we've actually seen interest rates suppressed policy-wise down to an extraordinarily low level. And I think that is kind of creating an environment of stress when it comes to retirement income. For a conservative investor, you can find yield, you can find income, but you have to take now what I'd say are some pretty large risks to get interest that was once commonplace. And then lastly, we're seeing demographically, I think societally, that we're seeing people living longer. They're living healthier lives. And it's extending their longevity. And the ironic part of that positive is that it also creates a strain on financial situations. You have to have your money last for your whole entire life. From the point at which you retire to the end, now it's extended for many, many people. And I think that's creating this search for income as well, the search for sustainability in your retirement. So the backdrop is that the three-legged stool is weakening. And I think it's weakening in various magnitudes for different people, but I think generally speaking, I can say that I think that the anxiety and the weakening is happening. And that kind of brings in this drive to find other sources of income to sustain retirement. And I think that reverse mortgages fit into that backdrop, among other things as well. So the first thing I want to do is point out that we've got a kind of a huge picture is that there's this total wealth of a household or an individual. And I'm creating simplified graphics here to kind of show the simplification of this idea. We've got savings on one hand, and we add to that this concept of home equity. And the statistics that I had recently read on home equity is that for people over the age of 62, now, and there's a particular reason I'm mentioning 62, and you'll see that, the total home equity across the United States is something north of $6 trillion. So that's a lot of equity embedded in a home. And when it's embedded in a home, it's typically not producing any income. So I'm talking about people's primary residence is there's equity in it. You've paid down your mortgage that's sitting there. It's a total of about $6 trillion. And that is where I'm focusing this conversation, this talk on reverse mortgages, because that is the heart of what a reverse mortgage focus really is. First off, what is home equity? It's a pretty simple formula, and it's not meant to speak beneath you. It's to sort of make sure we're all on the same exact plane. The value of your house minus the amount you owe on your mortgage equals your home equity. It's the portion of your home that's actually yours. The other portion that is mortgaged is actually not yours, it's owed to the bank. And over the course of time, the mortgage changes. It typically declines. That's a normal traditional mortgage. There are two kinds of mortgages, not just one kind of mortgage. And I'm not talking about two different kinds of interest rates, floating or fixed. I'm talking about two different kinds of mortgage designs. The one we all know is called that regular mortgage. I actually kind of want to throw out the term forward mortgage, which typically isn't something that people say. They just say mortgage. That regular mortgage is a situation where you are making payments, the big green check mark, yes, you are making payments, and you start off with a balance and you make payments every single month and it declines to zero at some point and you own your house outright. And traditionally speaking, traditional financial planning would say that you want to get to the point where you've retired with no mortgage. You want to be debt-free in retirement. That is a classic principle of most financial planners, is to get to that point where you don't have a mortgage. It is not 100% universal that that's what I see when people come into my office. It's not necessarily universal in this audience or this viewership, but it is sort of the classic ultimate outcome is to say I'm entering mortgage without any debt, and a debt is a mortgage. You know, I'm entering retirement without any debt, and a mortgage is a form of debt. Now, there is a reverse mortgage, and it literally works in reverse. You own your house, and you begin to draw against the equity sitting in your home, and you build up. You do not make payments, but you draw money, and you build up your debt once again. So what once was yours is increasingly not yours. Becomes increasingly the bank's. But it's feeding you your wealth back to you. That's essentially what a reverse mortgage is. It is pulling value out of your home. Everything in reverse. You're not making payments and building equity up in your home. You are literally pulling out that value you created by owning the home. You're pulling it out into your bank account. No payments. Very, very different in reverse. I'm going to go through some basic qualifications because they are very basic. You have to be 62 years of age or older to get a reverse mortgage. You can't be 50, you can't be 59, you have to be 62 or older. This is designed for this product. This is designed for retirees. It's not designed for the 30-year-old who owns their house and wants to use it to go to on vacation. This is designed for 62 and older. I didn't say it's appropriate for 62 and older. I'm saying it's designed for that. Appropriateness is a much more complex subject, and it's really specific to each of your needs. And I say that not to say I'm going to give you less value in this conversation than I want to. It's simply that it's a reality that everybody's situation is unique, and this evaluation of a reverse mortgage has to be analyzed in the specific context of your life. Sufficient income is required. You do need to have sufficient income in order to get a reverse mortgage, but it's not that burdensome. It's not like your typical mortgage where you need to go in and show a lot about your finances and show that you have, ample income to make the payments and have a cushion of equity in the home and all of that. It's really saying, can you pay the property taxes? Can you pay your hazard insurance, your insurance on your home? Do you have enough money to make sure that you're going to keep this house up? That is the test. It's not a massive test, but it is the test. The lenders, and I'll talk to you about the government after this because the government is part of this. They want to make sure that you are not going to be in default because you simply can't make the basic payments on maintaining the house. And buying insurance, making sure the thing doesn't burn down and has no value, the lender cares about that. And you know what? They care about that with a forward mortgage, a regular mortgage, just as much. In fact, if you forget to put insurance on your house and you have a mortgage, they will force. It's called force-placed insurance. And it is extraordinarily expensive if someone has to force the insurance on you. But the reality is they're very similar in the sense that they both require that. Property taxes, of course, you don't ever want to have, if you're a lender, the government step in front of you and say, hey, they owe us money first on the value of this house because they owe us taxes. Taxes always come first. They're always first in line. Nobody wants to lend and have someone else step first in line. Good credit is not required. And I say these things flippantly. The reality is this is not a credit check situation. This is a different kind of much easier loan to secure. Age, sufficient income. And the final basic requirement is that this has to be your primary home. You can't do a reverse mortgage on a second home. This has to be the home you live in. And that's an important thing to kind of remember along the way because later I will circle back to that concept of the fact that this is your home. This is your residence. Okay, the question is we know what home equity is. The question is how much of that equity do you actually get access to in a reverse mortgage? And there's a complex, I say complex, I have a degree in math, so math isn't that complex to me, but there's some complex math for regular people to determine how HUD, and when I say HUD, for the first time I'm bringing in Housing and Urban Development. That is an agency of the government. They're deeply involved in this kind of a loan. And I'll talk to you a little bit about how they're involved. But HUD forces a calculation to happen that says, how old are you? And then they look at the interest rate environment of the day, and they determine this is the amount, the portion of your equity that you have access to. It's called the principal loan factor, PLF. We don't need to remember that. All you need to know is you've got equity, you don't get it all. They're not going to let you have access to all of it because they've got to protect themselves, and you will see why as time goes on in the presentation. This is a kind of a cheat sheet for you. The fact is the younger you are, the less percentage access you have to your equity. 50% of it is the actual number. It's close to it. 52.6, I think, is the number, and it changes. But about 50% for the age 62 person. That's about how much of the equity you can actually get access to with a reverse mortgage. And as you age, and you go up in age, and I think the number is 90 years old when it caps out, you can get access to 75% of your home's equity in a reverse mortgage. So it varies between 50 and 75 as you age along the way. When I say access to it, The question then becomes, well, how do I access it? What's the mechanism for getting my hands on the money in my home? And the options are a lump sum, actually getting a big check. And if you're interested in a lump sum, you can have a choice of having that lump sum get charged a fixed interest rate. And I'm bringing up interest rates for the first time because, remember, you're essentially taking money out of your house, you're borrowing against your equity, and then you're paying interest. But when I say paying interest, it's one of the under-the-cover things about reverse mortgages is you don't have a payment to make. No one is going to send you a bill or an invoice. There's no automatic deduction from your bank account. But you are paying interest on that money you borrowed. And the next month you draw money out, if you're drawing it out on a monthly basis, you will be paying interest on that interest. And then interest on that interest and interest on that interest. And if you saw that chart, it was a parabolic curve, meaning it is compounding. That's the way that it works. It is compounding. Very different than that forward mortgage where you're paying partly principal, partly interest. The next month you have less interest and more principal. The next month you have even more principal and less interest, and on it goes to the point where you're mostly just paying off principal and your loan is gone. This is in the opposite direction, interest upon interest. If you choose that you want a fixed rate to be charged to you, then the only way you can get access to a fixed rate is if you took out a lump sum. That is just a nuanced rule. You can also choose to take out a lump sum and choose to have a floating interest rate. So you can have a choice there. The other option is that you actually have what's called an available line of credit. So that available pool of money in your house, you can say, I'd like to just have access to it when I want it. I may not want it right away. I may not want it in a year. I may not want it in 5 years, but I want access to this equity in an available line of credit. And I'll tell you, if you choose the available line of credit option, then you will be paying floating interest rates. That's the only choice you have. So they made it pretty simple. If you want a fixed interest rate, then you will be forced to do a lump sum. If you want a floating interest rate, then you will be choosing between either a lump sum or a line of credit option. Okay? There are limitations on this lump sum, on this fixed rate choice. If you choose the fixed rate, then you are dealing with a lump sum. I think I've made that hopefully clear. But you can't have every single penny of even your available equity. So there was this equity pile, and then I told you it was either 50% up to 75% depending on your age. Even that total, you don't get it all up front. They want to limit how much you can get access to. First off, if you want a lump sum, you will take either 60% of your available pool of equity that they are making available to you. You get 60% and that's it, and you don't get any more. Or you can take out more than that if it's been being used to pay off your regular mortgage. Because think about it, you can actually go, and we'll get into this in an example, you can actually go and take out a reverse mortgage, take out a lump sum, and pay off the loan that you have that is your regular remaining mortgage. It is one of the uses is to say, I have a payment, and now I want to take the equity that I have in my home, and I want to use it to pay down the rest of my forward mortgage and eliminate my payment. You didn't eliminate debt, you changed the form of the debt. But we'll go through an example of it. So this is a rule on a fixed rate. If you want a fixed rate, you will be dealing with a lump sum. If you're dealing with a lump sum, you cannot get access to 100% of your available equity. And that available equity is not all of your equity to begin with. Or you can use it to pay off your regular mortgage if that happens to be bigger than 60%. And I have a little circle there that says plus 10%. So the government actually says, if you take out a lump sum in a reverse mortgage and you're using it to pay off your regular old mortgage, you can pay it off, and we're going to leave a little bit of the equity that we were going to, making available to you, we're going to let you have 10% of that for whatever needs that you might have, covering closing costs, repairing something on the house, a small little extra lump sum of 10%. So I call that the regular payoff mortgage, pay off your regular mortgage plus 10% option. The other option is that line of credit. And the line of credit has a lot more flexibility. The line of credit option allows you, and I'm throwing out some terms here that I'm not writing down. I'm trying to give you concepts. You can be in a situation where you say, you know what, I have a line of credit. I've opened up the reverse mortgage. I haven't taken anything out, and I'm just going to take money as I need it on a self-serve basis, I call it. It's available. It's there. Maybe I use it, and this is not uncommon. I've talked to reverse mortgage people, and I will say, I won't use names because this is not a time to mention names, but I will say that very kind people who explained the product in detail to me at different times when I had questions, and I very much appreciate it. The self-service can be used for, an example would be given, paying property taxes in the summer. Once a year, a person takes out money in July to pay their property taxes, or they take out money for, a Christmas gifts to their grandkids, or whatever it happens to be. It's totally self-serve, pulling money out. It can be used also to buy groceries. It can be used for really any purpose. It is your money you're actually taking out of your home and then paying interest on it and paying interest on the interest. So never forget that aspect. You are really borrowing money. You just don't have a payment obligation. So self-service is one option. Another option is you might actually say, I want to take out $50,000 over the next 5 years, monthly. So I call that I put a little symbol there of 10 years. Maybe you should use the 10-year example. I want $100,000 over the next 10 years. And you get a monthly payment for 10 years. You can change it. You can turn it off. You can turn it on. But you can set it up that way. Okay? And you can also have lumps that you grab every so often to say pay for property taxes. I mean, it is your line of credit. If you're not familiar with a line of credit, it's pretty flexible. This lifetime one is a little different. By the way, they call that one where I said 10 years, they call that a term option. You're essentially getting a monthly payment for a term of time. The lifetime circle is a word that sounds like a number, but it's not. It's the tenure. Like, you get tenure as a professor, T-E-N-U-R-E, that you are setting up a payment that is designed by actuaries to say, here's the chunk of available money to you, equity in your home, and you're going to take out a monthly amount that is designed and guaranteed to last for the rest of your life. That's like setting up an annuity with your home equity. And that's what's called the 10-year option. The last option, of course, is that you can use this line of credit to pay off your regular mortgage plus 10% boost on top of that. So there are lots of options. Self-serve, lifetime, which is 10-year, a fixed period of time, which is called a term payment, and then lastly, this idea of paying off your mortgage and taking out a little extra if you want. I'm going to go through a couple of examples because there are some nuanced rules that you should be aware of. This is example one. You're paying off your mortgage, and you're doing it and you're getting access to what I call as a line of credit. So your intention is to pay off the mortgage, and you're doing it through that line of credit choice. So this is the setup. You've got a house worth $300,000. You have an existing mortgage, a regular old forward mortgage of $100,000. You are making monthly payments, and you're age 62. So you're just at the youngest age that you're able to do this. The first circle there is saying 50% of the value of the house is, quote, the maximum amount that you could ever borrow with a reverse mortgage. But you have a mortgage to pay off, so you actually have $100,000 eating part of that up. You following me? 150 is the maximum amount that you could ever get out against that $300,000 house, 50%, because you're really young. and you've got a mortgage that is sitting in the way, and it's $100,000, leaving behind $50,000 that's actually available to you on the line of credit. You use the line of credit, the reverse line of credit, to pay that mortgage off, and I put a little circle up there to show that, just so you know, you used more than 60% of the total amount that you could ever have available to you. That's a critical thing, because the government's telling you, okay, you've hit the 60% cap in that first year. The government does not want you to access all of your available equity in the first year. They want you to ease into it if you're going to do it. So they put a restriction on that very first year, 60%. Except you can exceed it when you are paying off a mortgage. So you could go all the way up to 100 as long as you're doing something that they think is worthwhile in their minds, which is paying off the other debt you have. In this case, if you did the math, and I'm going to do it for you, we used greater than 60% of it to pay off that mortgage. In fact, we used 66.6% of it. So it's bigger than 60%. So you breached the first year rule, except for the fact that they let that one exception, you've paid off a mortgage. $50,000's left. This $50,000 that's left on this line of credit, normally you could say, well, I can do whatever I want with that. I have all the choices in the world. I could pull money out on a self-service basis. I could set up a 5-year payment schedule. I could set up a lifetime payment if I wanted to with it. I could take out any amount of it that I wanted, except for the fact that that first year you hit greater than 60%. They then are saying you can't do any of that for at least 12 months. After 12 months, you can go back on self-serve and all the rest. Except for one tiny little thing, which I'm going to point out, is that in that very first year, if you remember, I said if you pay off your mortgage, they're also going to give you a little bit to play with in that first year, that 10%. Well, if you did the math, 10% is $15,000, and 10% of the $150,000 that you actually have access to is 15%. That's why I have $15,000 in that circle. So you're not completely cut off in that first year, but you did your best to almost be completely cut off. You paid off your mortgage. That was the goal. And so let me just kind of tell you what the use of this is for people that are interested in this. This person, this couple, had a home, and they had a mortgage, and they were making a mortgage payment. I didn't want to put numbers on it, because what's the point? It might be a mortgage that's in the last 5 years of its life or in the beginning. I don't know. All I know is, let's say they're paying $1,200 a month or $1,000 a month, let's say, in mortgage payments. At the end of this story, they have gone into a reverse mortgage. They have utilized the available equity to them, and they've used most of it, 2/3 of it, to pay off that mortgage, and now their budget has no mortgage payment. It's not that they don't have debt. They actually used $100,000 of that, and it is now interest upon interest upon interest, and it is eating away at their equity, but their budget, their income statement, feels looser. They have $1,000 more per month to play with, work with, gift, eat, travel, whatever it is that they're doing. And that's the story of what this kind of a setup does, is it creates this income or a relief of obligation, which essentially is the same thing. If I told you you no longer have a car payment, you'd feel like I'm that much richer each month. It's the same as if I said, hey, I'm going to give you $300 a month, the same cost as your car payment. You'd feel like, wow, I have more income. In the end, relieving of obligations is the same as getting income. And so that's kind of like the classic story of, I want to get rid of my mortgage payment with a reverse mortgage. But don't ever forget that you are eating your equity. You're not building equity, you are eating equity. And it has implications. I mean, I say that it has implications. You have to do the analysis in your life and understand what those implications are. This is a little simpler story. This one is a line of credit only. This is a couple that has $300,000 of value in their house, and they don't have a mortgage at all, zero. They own their house outright. They've gotten to age 62, and they own their house. In this particular case, they would get a $150,000 available line, and None of it is being used to pay off a mortgage because they don't have one. That $150,000 that's available to them, they can have all of those options: self-service, 10-year payment, which is a lifetime payment, fixed amount for a period of time, which is that idea of taking it out over, say, a 10-year period, or lump sums. It still applies, that lump sum rule. You can't just go in and say, well, I want all 150 in that first year. Can't do that. They'll limit it to 60%. You can't just go and grab the 150. So that is, I'm going to throw one thing out that I was not planning on throwing out. One of the interesting nuances of this is that that line of credit, this $150,000 at the end of this, I'm purposely, by the way, excluding all conversation at this point about costs, because there are lots of costs to talk about. This is not a free thing. You don't walk into a lender, get a reverse mortgage, and there's no cost. So you don't quite get 150 because you have costs involved. So this 150, though, that's untapped. At this point, no one has touched the 150. It's just there available for you. If you don't touch it, it'll grow. 150 available will become 155 available. The next year you don't touch it, it becomes 158. I'm not telling you exact numbers. I'm telling you is it grows with the interest rate that they normally would be charging you had you borrowed. And it will grow and grow and grow and grow, untapped, continue to grow. You can draw money out. The untapped portion continues to grow as a big growing pool of available money. There are financial planners out there that have recommended that people start up a line of credit, pay very hefty fees, but start up a line of credit because it will grow and grow and grow and grow and grow, and someday it'll be a huge number that you could tap if you felt like it. You might tap it for portfolio management reasons. You got money on the side, the market's down, you normally draw from your portfolio. You don't want to do that because I don't want to sell when it's down. I'll use my home equity line of credit from this reverse mortgage, and I'll draw money out and live off of it. Tax-free, by the way, I didn't mention that. Anything that comes out of a reverse mortgage, the payment to you, there is no tax. And why is that? It's your money. It's already your house. You don't pay tax on something you already own. So you pull out that money out when you want it, when your portfolio down, this is the classic use of this line of credit, and then you pay it off when the market recovers, and you take it and you pay it down, and now you have a fully available line once again. This is sort of what a lot of financial planners wrote. They wrote some white papers on it, somewhat complex, and they said, hey, this is a viable strategy. You know, the thing about it is you are using your equity in your home, and it's costing you interest, and there is no guarantee you'll be able to pay that back. And it's, let's get real, most people who are looking at reverse mortgages don't have large portfolios that they're trying to manage. What they have is an income need that is pretty pronounced, and they're looking for every place that they can look to get some income. So it's not, this is a niche solution. Upon analysis, it's a very niche solution to talk about, but I wanted to bring it up for the clarity of the conversation. So this is a line of credit, only much simpler. You have lots of choices. You just can't pull it all out in the first year. Okay, this slide is important for you to understand because it kind of brings in why we're dealing with the government and HUD. The what-if question is this. If I'm borrowing from my home on a reverse mortgage and it is paying interest upon interest upon interest, charging interest upon interest upon interest, and it's compounding and growing, and I live a long, long time, and I have a reverse mortgage that I've been drawing from and eating my equity of in my home, like literally almost eating it, depending on what you're doing with it. At some point, couldn't my loan get bigger than the value of my house? And if it gets bigger than the value of my house, then what happens? I mean, am I on the hook? Are my heirs on the hook of paying back the debt that's bigger than the value of the house to begin with? It sounds like a nightmare scenario. A reverse mortgage takes the value of your home and draws a line across that debt, and anything above that line is the shortfall, and the government eats that shortfall. That's why the government's involved, is the fact, and that's why they're restricting how much you can pull out at any one time. They're restricting, hey, if you're younger, we're not going to let you have the full availability to all of your equity because we think you could live a long time and this interest could compound and we could find ourselves underwater. And when you die or when you move, we sell this house, you sell this house, your heirs sell this house, and we're short. We need to make sure that doesn't happen. And if it does, we got to protect ourselves. Okay, so this is called a non-recourse loan. The non-recourse basically means that nobody has any other recourse than to just simply say that the house is the collateral. They can't come after your car. They can't come after your personal assets and your collectibles. They can't come after your investment portfolio. When you take out a mortgage, they're literally saying that house is the collateral and everything else is, I have no recourse besides this home. It's a non-recourse loan. And that's the case with a reverse mortgage. They can't come after more than what they're going to get out of the house or what your heirs are going to get out of the house. But because of that, you need to understand the costs of this. And I think it's important to see the costs because if you think about the invisible nature, and I was talking about this just before the conversation, there's an invisible nature elements within a reverse mortgage. The first invisible element is that I'm pulling money out of my house, I'm getting a check instead of paying in, I'm getting a check. Or if I choose not to get a check because I just simply paid my mortgage off, now I don't have any payments to make, but there's interest that I can't see being charged on the amount I've borrowed, and then there's interest upon that interest, and I never ever get an invoice. You get a statement, but the reality is if you don't have a check to write, there's an invisible nature to that. Here's some more stuff that becomes a little bit a feeling of invisibility. And it's not that it's not disclosed. Believe me, this is all disclosed to the borrower. It's just that you don't feel the impact of it because oftentimes all the closing costs, and I can say this pretty definitively, that the closing costs almost all the time are thrown in to the beginning amount of money that you owe on the reverse mortgage. So they fold it in. And I think that's pretty common for closing costs. You go to refinance your regular old mortgage. They say, oh, well, you don't have to make any payment. We'll just let you borrow the $2,000 of closing costs to start. Well, there's a lot more costs involved with a reverse mortgage to start up with. And you don't make a payment for them. You don't write a check for it. So it becomes almost undetectable, an invisible nature of it. It's not that it's not disclosed. It certainly is. So here's the very first thing. HUD charges an upfront insurance premium on this mortgage called mortgage insurance premium. Silly acronym, UF, upfront, MIP, mortgage insurance premium. That goes to HUD. The government wasn't taking this risk for free. They're the ones sitting there waiting to pay the bill when the house doesn't pay off the mortgage. They're going to make sure that they're collecting. First off, they're going to restrict you in how much you can pull out. They're going to put rules on it, and they're also going to say, oh, by the way, we're going to also charge an insurance premium because we've got to make sure that we are protected, we the taxpayers. We've seen how that worked out in numerous cases. In this case, they charge this 2% on the full value of your home. Quick example, that $300,000 house, the mortgage insurance premium up front is $6,000. That is the number, right up front. I will tell you, while writing my column for the Record Eagle that drove this talk, the rules changed on that 2% on the day that I sent it in to the Record Eagle. Because HUD is concerned about that risk more, and they've changed their regulations and said we're going to make this 2% instead of, in some cases, 0.5%. So the cost just leapt for people taking on a reverse mortgage in some cases. Some cases it went down a little bit, and I won't get into it. But the reality is this is a new number, 2% of the entire value of the house, $6,000. That's up front, right off the bat, to HUD. Then, as you borrow money, So think about it. You have your outstanding balance as you're borrowing money. You could have done it right off the bat with a lump sum. It could have been because you had a monthly payment coming and it's slowly building. The outstanding balance of the amount you actually have pulled from your home will be charged 0.5% on all the amount that you've borrowed every year. Just to give HUD a little bit of credit, because they just raised one side of it, the upfront, they actually lowered that from 1.25 down to 0.5%. So overall, the interest charges have come down as a result of what HUD just changed, but that upfront became more expensive, significantly more. And this, by the way, on the borrowing, it's added to your interest cost. Because let's not forget, HUD's not the only group charging a rate. The lender, the actual people lending the money to you right off the bat, there's a bank involved here. The government's just overlaying insurance on top of a bank loan. The government's not lending you the money, the bank is, and then the bank is getting insurance protection by the government. The government's charging for it. This added interest cost, right now I'll just throw out numbers, rough numbers. This 0.5% is added on to something probably in the range of 3.5% to 4% right now. Interest rates are low. So the reality is that it's floating and it can go up. There are caps on it, but it can go up over time if interest rates rise, which means that your interest upon your interest can compound faster. Then there is an origination fee, and it's not insignificant, and it's becoming more explicit today than it was last week. And I'm not going to tell you why. You're all smart. I could explain it, but I don't have time to. The reality is that this origination fee is becoming more explicit now. This goes to the bank or to the lender. There's a person who works for the lender, works for the bank, whose job is to originate mortgages for people who want them, and they get paid based on the amount that they originate. So it's just like any other business. You sell boats, you get a commission. You sell cars, you get a commission. You sell a loan, you tend to get paid more, and it's paid by the origination fee among other things. More so now by the origination fee than even last week. And so this is 2% of the full value of your house. That's how they charge the origination fee. So if that $300,000 house, the origination fee is $6,000. And I chose that number because that is the most that the government will allow them to charge, $6,000. If it's a lower amount of your house, lower value of your house, the origination fee will be lower. Okay? That's not an insignificant number. We have 6,000 here up front. We have 6,000 here. We're already up to 12. Then there are the traditional closing costs. There's title insurance and people who are preparing documents and credit report and recording fees and a bunch of other stuff. And I'm not an expert in closings, but I've gone through a few in my life, and the reality is a big long list of things. And it adds up, and I'm giving you a very rough estimate of a couple $1,000s. So what we've got is 6,000 plus 6,000 plus 2,000, all that's up front. Then you have your ongoing 0.5% tacked onto your interest rate, which is not that high at this point. But we're talking about a total of, let's say, $14,000 on this $300,000 home, trying to set up an available reverse mortgage line of credit, let's say. Well, that available amount for that 62-year-old is around $150,000. And we're talking about $14,000 of upfront costs just to set it up. That's almost 10% right off the bat. And oftentimes when you set it up, that $14,000 is immediately folded into the loan. So now you don't have $150,000, you've got $134,000 or $136,000 available, and $14,000's already been drawn, and it starts earning interest on interest. You don't have any payments, but the interest is there. This kind of brings up a few things. Before I move on to this, it brings up this. That cost is so high that it requires you to recognize the long-term nature of the decision you're making. The last thing on earth one would want to do is take on a reverse mortgage if they were going to change their mind about staying in their home within short order. Because if you were interested in tapping your equity and leaving after 5 years, it's way cheaper to do just a regular old line of credit, go to the bank and say, I've got a home, it's worth X, I don't owe anything, and here's all the information about me, please give me a line of credit. And if you needed to borrow from the house, you can borrow that way, and then you sell your house 5 years later and pay that line of credit off, way, way, way cheaper than setting up a $14,000 cost that now you've reversed course 5 years into it. That was a very expensive way of tapping some of your home equity. So this is a long-term decision that has implications, which I'll get into. Quick things here before we kind of wrap this up. Triggers to pay back the loan. These are the triggers, meaning the government forces you to pay it back. Because you're borrowing, no payments, borrowing. It's built up debt inside your home. Someday they want their money back. There are triggers, 3 of them. 1, you stop making your mortgage, your property tax payment. You stop making your hazard insurance payment. You get your house in such a state that of disrepair that somebody from HUD somewhere, some inspector comes in and says, you know, this house is degrading and falling apart. We need to kind of sell this thing. That's very rare because they don't have people going out there knocking on doors, at least from my understanding. The first 2 are not rare. 16% apparently of all existing reverse mortgages that are out there today are in default. And they're partly in default because the people could not continue making their mortgage payments. I mean, their property tax payments or their hazard insurance payments. That kind of gives you an idea of the type of clientele that typically gravitate towards a reverse mortgage, is that in those particular cases, they were not able to even make what I would say are the basic maintenance level payments to stay in this mortgage. That's not all of them, but that is a subset. The second one is that the second and third are pretty similar. It's no longer your residence. It's no longer your home sweet home. You're gone. You're gone because you've decided to move out for whatever reason. You might have been forced out because of illness. You've been in a nursing home. You're gone for longer than 6 months. Then you ask for an extension. You're gone longer than 90 more days. You ask for another extension. You're gone for more than 90 days. Now you've reached about 1 year, at which point this is no longer your primary residence. And then that's the point where they say you need to pay this back. So you then need to sell the house. You may have eaten up all of your equity. You got to be 88 years old. It hasn't quite gotten to the point where you owe more than the house. You sell the house and you end that whole trade with very little equity, and now you're in a nursing home. That can happen. It's more than can happen. It does happen to people. So you can't be in your house. You don't have a choice. I wrote that in my column that there are multiple reasons that you might be triggered out of your house, some of which are not under your control. That's one. Number 2 is similar to number 3 is similar to number 2. It's not your primary residence because you're dead. And that's one you probably couldn't control. You're dead. Same exact rules apply to your heirs. You've been dead for 6 months trying to sell the house. You've asked for a 90-day extension. They've asked for another 90-day extension. At some point, it's gotten to the year. The reality in that case is HUD and the lenders do not want to be in the game of foreclosing on homes and trying to sell them. They just want you to sell the house. I say you, the heirs. They want you to unwind it. So in all cases, you get about a year, and those are the triggers. You can't make your payments on the basic things you're supposed to maintain the collateral. You can't live there long. Live there. It's not your home sweet home anymore, or you've died. Those are the triggers. So back to the big picture, total savings, home equity. We are talking all about the tapping of the home equity piece of it. But there are some things I think that we need to deeply consider before you talk about a reverse mortgage with anyone. First off, I will tell you, HUD made changes in the last 3 or 4 years. One of the changes they made is they said that everybody who gets a reverse mortgage needs to go through counseling with a HUD-approved counselor. Now, I've never been through the HUD counseling, so I have no idea what the quality of that counseling is. I would say you also need to talk to a trained financial person that you can trust to say, look at my whole life situation, and I'm thinking about a reverse mortgage, and I need to make sure that and this should be done prior to retirement and even after retirement, if you're finding yourself in a position where a reverse mortgage is seeming good, you need to go through this whole evaluation with a trained person to say, there are lots of other options, or there are some other options, or frankly, there are no other options for you. I'm not saying a reverse mortgage is the last option on earth that one should consider. It fits certain people. It's not a mass market solution for everybody. Because think about it. Inheritance. If you had in your mind that your home was going to be something you would pass value along to your kids, or even pass the home along to your kids, you've eaten up the equity in that house. The only way for children to keep the home is to rebuy the home, because they got to pay that mortgage off. Number two, it may be the only asset you have to pass along at the end of the day that they're going to sell and get some value. So inheritance might be something that's very important to you. If you go into a reverse mortgage situation and you eat up your home equity, you may not actually be able to meet that objective. It's not the objective of all people, believe me. There's a whole growing group of people who are younger saying, I'm just going to die broke. I don't want to leave anything to my kids. I educate them, that's fine. And I have no argument with that. It's just, these are conscious choices. Number two, long-term care. Some people actually look at their home equity as this kind of, and I'd say that I've brought this up to multiple clients. The value you have in your home can be utilized at the end of your life when you move out of that home because you can't be there to actually pay for the long-term care needs that you will have and not be dependent on others. And it is an available pool to you at the time that you need it. It's not a lovely way to spend money, but it is security, knowing that you have resources for it. You eat that home equity up, you don't have that anymore. Then finally, this one's a little more psychological. You know, security and independence in that home of yours. I mean, this is a generational thing. I think in some cases it probably isn't generational. It's probably just my age. The fact is that when you've paid off that traditional model of paying off your mortgage and owning your home, that is powerful to the psyche of a person. I own this house. I own this. Nobody else can touch it. Yes, I have to maintain it and pay property taxes and insurance, but it is my home. When you eat away at that home equity, you eat away at that sense of security and independence. And it can have a detrimental impact. The worst outcomes are those outcomes where a person takes on a reverse mortgage, borrows against their home in all those various forms, eats the home equity, they never make a payment, they never really see any obligation, but it's building, and the interest is building. And then they realize at the end of their life in that home that they have to sell it and they have nothing, or they have a tiny amount left. And now they're out of their home because they've been forced physically to leave, not by the government, because they physically had to go. And they have very little left. So the security and independence part of it's critical. So I will wrap up by saying that there are lots of things to consider beyond this. I can't get into all of them. There are tons of things to consider about the ultimate need for a reverse mortgage is typically because you need income. And the tools of gaining more income or the feeling of needing more income, those things are all about budgeting, career development, the retirement decision to begin with, going down to part-time, working until you're 66, 67, 68, 70, being able to extend your work life and shrink your retirement life. These are all component parts of the big picture planning that I think people need to be doing actively and proactively before they get to the point where they say, I'm retired, I'm looking at all of my assets, and that home is worth a lot. I want to start eating that home equity. It's not all good, it's not all bad, it's very, very complex. And so that's the reason I chose reverse mortgages and how they work. So I appreciate you listening. I will say the last little bit here is that, again, I want to thank Traverse Area District Library for this incredible facility. The Senior Center Network is an incredible asset for our community, and I hope that all of you and all the viewers are able to go over there and see the programs that they have. We should be very proud of them. And lastly, Up North TV and Channel 189 for having giving us the opportunity to really put this out on the air and educate people on financial topics. So with that, thank you very much.